Welcome to the Motor Carriers Insurance Education Foundation in-depth review of coverage addressing the unique operations of motor carriers. This session will be the importance of the coverage forms. These webinars are not filed for state CE, and there's a learning opportunity only. If you want state CE, contact our office and we can help you with that. If you have any questions, please send them by an email to trs@mcief.org and we will answer them as soon as possible. Insurance policies. Insurance policy is a contract between the insurance company and the insured. Understanding what the contract obligates the insurance company to do and the insurance company responsibility is very important. The contract must be read by the insurance agent as well as hopefully the underwriter and the company. It must be understood. A lot of provisions are hard to understand, and you have to explain to the insured about the policies. The insured is not expected, in my opinion, to know the policy. It's our obligation as insurance provider to explain to the insured how the policies work. You got to make sure the contract is set up so at the time of need, it is clear what our understanding of the parties were that the policy was going to do. Do not provide an insurance policy to insure until you have, as an agent, read the policy, understand insured's operations and exposure, make sure the policy addresses the operation, and if not, offer other policies or explain to the insured where they could be a concern with coverages. Make sure the insured knows what their obligations are, as well as any limitations and requirements. Insurance provider, company, or wholesaler. When you're providing the policy, you need to provide information to the agents concerning your policy you will be providing. You got to make sure the policy quoted and bound meets the request for coverage in the application. If not, discuss and explain with agent. I'm talking to the wholesalers and the companies now. How often have you seen, particularly insurance agents who do not understand symbols and who have not write trucking, ask for any auto, because that's what they do for any other risk. But we know in trucking, motor carriers insurance, you do not get any auto until you have a fleet. But how do you respond when the agent asks for that coverage and you don't give it? We need to come back and tell the agent, this is not available, we cannot give it, or here are the conditions here. This is what you need to explain, because the agent expects to be produced what's asked for. The 2 or 3 errors of omission cases I've been in, most of them, or a lot of them, when there's a coverage consideration, is between the time the policy was bound and the policy got issued. And so that's important to understand both and make sure from a company standpoint that you respond to the request on the applications. You got to understand the insurance operation too. The policy does not meet them, provide areas of concern to the agent, meaning that if you know they have an exposure for pollution, for example, and the auto policy does not have the pollution buyback, you need to tell the agent, we do not provide pollution coverage in our policy caused by cargo. Might be something you want to write a standalone policy or talk to an insurance company who can add that coverage, but we cannot. It's important to have that relationship between the two parties, because as an insurance provider, you have one set of policies and one routine that you do and your standard offering, where an agent deals with a number of carriers and they do not take the time, unfortunately, to read all the policies that might be presented or might have the opportunity to present. So it's important for that to be understood. Most of the policies are standard. When we talk about standard policies, the ones that are produced by the Insurance Service Offices, ISO. They develop policies. They also collect costs, claims costs, and publish loss cost factors so that the insurance company can tie whatever they want to add to those loss cost factors, like overhead, profit, insurance, retail agents, commissions, and those things to those loss costs. This allows for the area where you have by classification code and you have geographical area what other insurance providers have experienced for that class of business in those areas. So it gives the insurance company at least some place to benchmark where they're going forward. They also represent the insurance companies to seek approval of forms and rates with the Department of Insurance for each state. This is an important consideration because the states make sure the forms that are being filed by the insurance companies and ISO doing on behalf of the insurance companies meet the citizens of those states. And the rates are adequate to prevent a profit, but not punitive of being too much. This is a balancing situation, and a lot of states are hard to do. For example, I was teaching a class a number of years ago in Virginia, and I made a comment when I teach it that the only really difference between Virginia at that time, the mandatory coverage going back to the 1980 form, even though it was in 1999 or so when I did the program, said the only real difference is pollution. How Virginia mandated by special endorsement for pollution to be covered under the limits of the policy, where the standard ISO policy not. Unfortunately for me, there was a person who worked for the Department of Insurance in the CIC audience who raised their hand and says there's 102 differences. So the states take that very careful to make sure that the policies that they're accepting to be written for citizens of those states meet those requirements. And that's an important part the ISO plays as they file these new forms and update the forms and be more addressing problems or even expanding coverage. The ISO policies commonly used are both auto liability and physical damage, general liability, and property at fixed locations. Some insurance companies develop their own, typically based on ISO. Progressive, Auto Owners, Great West Casualty are typical companies with their own. Some insurance companies provide coverage on a non-admitted basis. And again, I refer you to the session that we did in admitted and non-admitted. What happens there is they have some opportunities to not follow the ISO because they're not licensed in the state they're issuing coverage, so their policies do not have to conform with the policies that have been filed with the Department of Insurance to meet the citizens of those states. When not ISO, the provider needs to explain the differences to the retail agent. Retail agents must make sure the insured understands the differences and explains any area of concern again when replacing ISO policy with a non-ISO policy. That's a big consideration because when you look at the policy you're delivering, are they different than the policy the insured has bought before? This particularly is important for property coverages and cargo coverages, and to some extent auto liability, but there are very few differences in those, and we'll talk about those as we go through this session. Cargo in the marine is a little different. IAIS is used by a large number of insurance companies, those that do not develop their own form. That's just the kind of standard in the cargo area. They do other things, builder's risk and MOP policies and COP policies and all those kind of things in the marine products and provide policies. But then marine policies typically do not have to be approved by the state. So there's a little less stringent on the policy types and wording as approved by the state than you do in the standard ISO for auto liability, physical damage, general liability, and property coverage fixed location. ISO does have the marine policies, but cargo is not often used their policy. Insurance companies that specialize in providing insurance to motor carriers typically have developed their own policy. So you got to understand, is this a developed policy for that insurance carrier or is it an IAIS policy? The specialty carriers that most of you deal with that I'm aware of will have their own cargo policies. Some carriers, London being one, provide auto physical damage on the marine form, and in some cases. So this is a concern that you would have, because as we go through the auto physical damage, the London in the marine form could be different than ISO auto physical damage. So when you deal within the marine, realize that every policy could be different, even more than auto liability, general liability, physical damage, and fixed location. So that's a concern. And probably later, if we get into this presentation, one of the major concerns about understanding the policy. We'll talk very quickly about work comp. All work comp policies are the same. There's no wording there. The only difference is that it meets the state compensation laws. This is where it's different, and the state spells out the benefits and who has to be covered by work comp and whose obligations provide the coverage, and if not, where there's certain immunities established or not established. And you list in the states 3A and 3C. 3A is where there's a known location of policy issuance. 3C is an unknown. Think in trucking terms. 3C is where the truck drives through the state, but there's no physical location. 3A is where there's a terminal or the driver lives or a recruiting office. That would be in 3A versus 3C. Each state law could or will be different. They'll show who is required to provide work comp, meaning the employer, but also at what level of employment needs to be provided work comp. And it also shows who's covered or not covered by the state law. And that's the concern that we have in trucking when we use owner-operators, independent contractors. Are they an independent contractor or employee or not? Are they subject to work comp or not? Are the premium they develop from the payroll subject to audit or not? And is tort immunity extended or not? If your insurer's using owner-operators, meaning that they have someone who they lease on to their fleet, that person they lease on has their own truck, they bring their own equipment to the fleet, then you have to determine how the work comp policy is going to address that part of it. And that's the concern that you would have anytime the insurer uses an operator. The biggest concern from an agent standpoint is audits, because if that's not cleared up front, the insurance company will come back and audit and put all the owner-operators' payroll into, settlement into the payroll and send a big audit. You need to clear it up before you write any work comp policy on behalf of a motor carrier, if they're using owner-operators, how that insurance company who's writing the primary coverage for the motor carrier is going to address the premium and the coverage for those owner-operators. The work comp policy provides benefits, indemnity. That's loss of wages. Most of that is pretty common in those areas. It's based on average weekly wage with a maximum minimum. In most states, the maximum now for annual is somewhere around $50,000, so not much difference. Impairment is where it can be greatly different. This is where I'm not as good as I was before, so therefore there's some additional remuneration in the payroll area, in the indemnity area, to pay me for what I cannot earn now that I've been injured that I earned before. All medical is paid the same. Death is also where it differs, because that is not a life insurance policy. That's benefit to dependents of the killed employee who died during a work performance. And so you need to check those states. Like Florida's about, the cap's $155,000 currently, and other states like North Carolina for the same death could be $450,000. So that would be a concern you have. Burial's all basically all the same. That's what it costs to handle the dead person to the grave, and that the policies vary between between 5,000 and 8,000. No big deal. The biggest concern I have, going back to the owner-operator, is sometimes the owner-operator buys their own policy. That's an occupational policy. That's an individual health product bought by somebody, and that protects the owner-operator. But it is not the same as work comp, because it has limits in it, both how much could be paid and also how long it's going to be paid. Work comp does not have that. It's could be included in some other health policies, but all of them are different. And so don't ever think that work comp is the same. Don't ever say work comp is just, don't think accidents and occupational policies are the same. They all differ, and make sure you understand occupational accident policy is not work comp, and explain that both to the insurance company and also who's riding the fleet, to make sure they accept that and do not charge the payroll of that owner operator into the premium, but also for the motor carrier and the owner operator to understand the differences and how each are provided protection in the work comp or OC Act. Let's talk about for a few minutes types of policy. First party. You'll hear first party. They're a property form. They're address protection to fixed assets owned or responsible to be protected by the insured, meaning their assets, and it's first party coverage. The beneficiary there is the person who owns those assets or has insurable interest in assets. Third party liability. These are, third party policy. These are liability forms. This is a contract of indemnity. When you hear the term indemnity, what that says is the insurance company agrees to indemnify, to pay on behalf of the insured any damages the insured does for the payment of premium. The insured motor carrier, if the motor carrier damages the public and is legally liable, then the insurance company agrees to indemnify, pay for that. They pay, and also defense. In fact, that's one of the things that I think that's most important is the defense, and the duty to defense is broader than the duty to pay, because we have to defend till we make sure that the coverage we might deny has been held up in court. The first thing that we respond to in the policy is to defend the insured, and the first thing insurers ask for is to be defended. And it will pay up to the limit. Now, most of the time, there's a couple of policies out there you need to be aware of, particularly general liability. There's a couple of auto providers out there, and then excess coverages where the defense is within the limit. But most defenses for the standard ISO policies and policies based on the ISO is additional to the limit. And the two most commonly used liability forms is auto liability and general liability. I've been doing this for a long, long time. Even though the policy states, read the policy carefully, the insured will never read it, and coverage for the most part will not be understood by the insured if they read it. When I teach this often in a face-to-face, I say we don't even want the insured to read it because they might ask questions that we have to answer, and that our annuity is that we keep them confused and baffling, so they have to come to us to address the concerns in the policy. So realize that that policy that you read is complicated enough, and no court has held up where the insured has to understand it and read it. Individual, small, one owner, LLCs, corporations do not completely understand the difference between themselves or the legal entity. So we'll talk a minute about setting the policies up. And there is a flaw that a lot of them think that if my legal entity, LLC or corporation is covered, then I'm also covered. In auto liability, they're not. And in general liability, they're not either. Those are things you have to address, knowing the difference in those. And so when you talk to a smaller motor carrier who is operating as an LLC and as a corporation, which is a sub S corporation, you'll ask them, what do you do? And you'll have to then ask them, which you? Corporation himself, who owns the units? Which you? Who owns the buildings? Which you? That's the concern you have. The more words, policy and policies, more exclusion limitation. So I like a policy that's very short and sweet. The more things that you add to it, the more complicated it gets. I looked at a policy and compared the difference between two insurance companies where the standard ISO was about 16 pages. This company's policy was 42 pages. I mean, it just, the more particular items you have in the policies that will reduce the premium, the greater chance that at time of loss it will not address what the insured anticipated, which gives you as an agent into the E&O exposure. And every time I've been in court cases, the insured says, all I hear the agent say, you have full coverage. How many of y'all have heard that? What does full coverage mean? I have no earthly idea. And but yet we say it all the time. We need to be careful about that. We don't want to overpromise. We want to understand what we're promising and be careful about making sure the insured understands that. The other thing I have found, the insured will also always pay to have coverage after the damage or claim. So unless you tell them where the limitations are, unless you tell them what they have to do, they're going to expect the coverage. Early on, I was involved in a case many years ago concerning a hurricane where the insured said, well, why wasn't that dirt that got washed out by the storm not covered? And in that situation, they found some weird company who said, we will cover the dirt. And the insured said, if you had offered us that policy, we'd bought it to have that dirt covered. Well, folks, you think about these things, but you've got to realize that the insured expects everything covered. And if you're not covering it, then you have an exposure later that says, I would have paid for it. So this is where you have to be careful to explain to the insured where there is no coverage, and in all possible, offer coverage. I hate this checklist you do, listing flood and EPL and directors and officers liability and cyber liability, and you check those things off. If the insured has the exposure, you need to explain what those other coverages mean and how the policy that you're offering does not cover those things. I have never seen where that checklist really protects the insured later when a crash happens, when a claim happens, and it's from a known exposure where the insurance agent did not offer some alternative or put out or tell the insured why it's not covered going in that limitation, so they can modify their operation and or buy coverage from some other insurance provider. Let's talk about who the insured is. They're the entity that owns the assets in the property coverage form, first party coverage, and the owner of the assets that could be seized to take care of a liability claim in the liability third party coverages. So it goes back to that. Now, you in all policies is a legal entity listed on the name insured line. So you need to verify that the legal entity owns those assets. You need to check with the state records. Entities with the tax ID number, because the tax ID number talks about the ownership of it and who has to report the profit or loss in those operations to have to divulge the assets that they own, and they're the ones who take depreciation. In trucking, we also have another one, and that's involved in who the license plate's issued to, or the state or federal DOT number and MC number. Those will have the federal, and sometimes that could be different because not all the ways does the insured tell the state or tell MC exactly who owns the assets. They think like Tommy Ruke doing business as Ruke's Trucking. That might be the DOT number, the MC number, but the assets there is Ruke Trucking, we hope. Ruke Trucking LLC, we hope, not me personally. So we got to sort those things out. You go back and verify. Who's the tax ID number of the insured, and is this tax ID number, if it's different than what they've told the state for the DOT or the federal for the DOT number, federal number, you need to work that out before you issue the policy. Fixed property, buildings, personal property, those things. Suggest placing this in separate legal entity than the trucking company. You want to get all assets possible away from the trucking company operation. You don't want to expose any real property, those are the buildings, the personal contents and those things, from a lawsuit derivative of the trucking company of that 18-wheeler running down the highway with skull and crossbones on its grill, where any jury will have been scared by that trucking company and will want to pay more money. You want to separate all other entities away from that are not part of the trucking operation. And again, this is the first place, and that's the building, the property, the personal goods. And those policies you have to concern. What's the limit of coverage? That's what the policy is worth. The premium is based on the maximum coverage for each item listed. And that would be in property coverage a co-insurance consideration. If you do not list it to the level, typically 80%, then there's a penalty for not having the right limit. That penalty is not really punitive. It's to ensure that the insurance company is getting adequate premium because their rates are filed to make sure they have, quote, full coverage. Never think that limit at 80% is going to pay for full coverage. You want to make sure that you have the full limit of what it's going to take to replace it. And you have the replacement either two ways. Replacement cost, that's where it's something old that you buy something new, or ACV, which means that you replace it the same way. For example, if you have a building and a roof gets torn off, if you have replacement cost, then there'll be a new roof put on. If you have ACV, then the new roof will be put on, but the insurance company will bear a deductible, a betterment fee between what it was worth before and now, because it's new, what it is now worth. And so that's the betterment fee. So you got to be concerned about that. Cause of loss, you have the special or the name. Most of the time you have the special cause of loss. They'll be deductible. One of the things we're finding here in Florida, unfortunately, because of hurricanes, most of the deductibles you get used to where there is a flat amount, $1,000, $5,000, $10,000. But Florida, for windstorm and some other states windstorm, that deductible is listed as a percentage. A percentage of the limit becomes deductible. This is a concern here because sometimes those people, when it was first got put relevance for hurricanes and windstorms, particularly in Florida, what the consumers thought was it was a percentage of like the health insurance where you pay a percentage of your bill. No, this is a percentage of the limit of the policy, not what you pay. And so that's got to be explained too. If there's a mortgagee, you got to make sure they're protected and the check is put in their name as well as the insured. And then there's business interruption. That's something we forget. Business interruption is very important. That's to keep the insured going after something happens. There's two situations for business interruption you need to be aware of. The first situation of business interruption is loss of earnings from that location. If you have a store, if you have a repair garage, it's not there, so therefore, or a factory, manufacturer, it's not there, so you can't manufacture loss of earnings. You also have extra expense. Extra expense is where the insured cannot operate out of that location that has been damaged, that triggers a business interruption, and will pay for the cost of them to operate at another location. In trucking, that's where the exposure is. It's not loss of earnings. It's the extra expense needed to keep them operating by leasing another location, by moving their assets to another location. The reason I point that out is that the extra expense is less costly. Extra expense is not subject to co-insurance and other things that business interruption is. So when you look at it, you need to look at both of those, but mainly for trucking operations, you need the extra expense, not the loss of earnings in all cases. Again, make sure you understand the insured's operation to determine which one of those exposures they have. The property motor carrier has that's real property would be their tractors, their trailers, equipment. I throw equipment here. I'm talking about forklifts and tarps and binders and those things. How provided? Do you provide it as a combination of auto or is it standalone coverage, physical damage coverage? Item to be covered, again, the assets, all property insured, covered or not. You need to go ask the insured about these items and all these assets, and at policy issuance, do you want them covered or not? And you also need to talk about the newly acquired, do they have to report it or not? Those are the two things you need to go over. I asked my insured, let me have a list of all your assets. Let me have a list of all your rental contracts that you might be responsible to cover the items that you're rented, and ask them, do they want coverage or not? And also ask them what it's worth in real dollars to replace it just like it. And then talk to them about if you have one, purchase one new in the year, you need to tell us about it. That is not as much of a concern as you would in auto liability, particularly owner-operators vehicles, because in most cases, when your trucker buys something new, they'll usually borrow money on it. And the lending institution, either the building for the forklift or for the tractor trailer, would call you up and ask for proof of coverage as their agent. And so that will give you a hint. You must list the units in the policy, the make, model, VIN number, equipment, and then that limits. And that's where the limits is where it's so important to set those limits properly. Because the limits is a premium base, but the limits also the most that would pay for a loss. What is the item worth in real dollars, including all the equipment? The equipment does not have to be attached, so you got to include the tires and the tarps and the chains and the binders and the snow plows and the auxiliary power units, those things. You need to ask the insured every renewal, never renew as is. You've got to go through this as every renewal because all property coverage changes from year to year, the value. What something's worth this year is not going to be worth the same a year from now. And so you need to go through every year. Your main concern in trucking is miles are more important than years. That's different than personal autos. That's different than everything else. But the trucker can have a risk and have two truckers where one trucker buys a vehicle, pays $150,000, and they're getting 100 to 105,000 miles a year. Where you have another trucker who pays for the same 150,000 unit, but they only get 80, 85,000 miles. That difference in 20,000 miles a year in 2 to 3 years can make a difference that's 15 to 20% on the value of that unit, because it's closer you get to the maintenance, which is about 550,000 miles. That's when the value of the truck becomes less. You also have to worry about lost pay, and that's called gap coverage, because the insurer does not understand that even if the finance company or the leasing company requires them to cover it for X dollars, at time of loss, we're going to pay ICV. And that X dollars required is not what they owe on it, but at time of loss, particularly if it's a newer unit with low down payment, and it will not be worth the same ACV as what's owed on it, and you don't collect the limit. If you add gap coverage, then you would collect the limit enough to pay the note off, as long as the limit does pay the note off. So that's the concern that you would have as you set the policy up. The other cause of loss, most of the time you're going to have comp and collision. That's almost all risk. The only three exclusions you have is nuclear contamination, road damage to tires, and wear and tear. It's available for most all insureds now, unless the equipment is very, very old. Specified cause of loss plus collision, that will add to that. There are 7 causes of losses. That actually covers most of them. Today's marketplace, again, comp and collision is commonly found. And the reason insurance companies are offering comp and collision, where in the past they did offer more limited coverage, is that there's not that much differences in what can happen to a truck that would not be covered under specified cause loss and collision with a $1,000 deductible that comprehensive. And comprehensive is just what a retail agent used to purchase. So if your carrier is offering specified cause loss, you need to be concerned about that slightly. Not a big concern, but you just need, again, to point out to the insurance company. Deductibles, that's another difference than you have anybody coming from the auto arena, personal auto, or even property arena. You have all cause of loss deductible, where in a lot of auto policies you purchase, there's a different ones for comprehensive and collision. Typically, you start with $1,000 for all cause of losses. You also can have some enhancements where you have a combined deductible or a disappearing deductible. Combined deductible addresses in the trucking arena, where you have a tractor trailer that gets damaged at the same time, and you have 2 items now, and the question is, is there 2 deductibles or 1? Most of the insurance company will offer you a combined deductible, which says we'll have at this time of loss to have apply only one deductible, no matter how many items we're insured to get damaged. A lot of times you can even roll in cargo on that, which will be really beneficial to the insured. You also need to think of loss use, rental reimbursement, loss of earnings. Those are done by endorsements. This will keep the insured going when their truck gets repaired, when the truck gets replaced, if it gets stolen. This makes the client still be with you at time of loss, and after they're now ready to up and run again. Record bills, this is a big concern, and this is where the policies can vary. It's covered because of protective reserve, and it says keep records, but it does not promise to pay the expense, just says keep them. Your concern is, earlier what we just said, the maximum we'll pay is the limit. If needed a limit to repair or replace, then where are the dollars for the record bills? Companies vary. Some of them will pay in addition to the additions to the repair and replace, and we'll have unlimited. That's standard property coverage with protective reserve. Some will say we'll pay the record bill, but no more than the limit. And some companies had a record bill endorsement that usually limits it. So the concern you have is, do the record bill. The other concern you have that will give in a claim happen, can it be repaired or not? A lot of insurance companies want to have a total loss because that benefits them to close the claim, but the insured might not want it to be total because they have a mortgage on it. They want it fixed. So you need to look at the record bill, the cost to repair, replace, plus the salvage. And that's the big unknown, because sometimes we can have a lot of salvage. That's what the items, the engines, the transmissions, the rear axles can be sold at a price later. And so that if the repair bill plus the salvage equals or exceeds the worth and the limit, then it's a total loss. The insurer says, yeah, but I owe money on it and I don't want to finance it, because they're not really getting, in most cases, any equity back enough to pay another down payment. That's your concern you have. A different concern is in the marine, instead of auto physical damage, Lloyd's contracts and others could be written on in the marine form. They'll have more exclusions, mainly to the employee exclusion and also overweight exclusion that would be found in the marine products that are not found in typical auto physical damage. There could be a few others. The equipment also typically must be attached, and they'll use special cause of loss more often than the auto physical damage riders. If a loss happens, crash, stolen, other, will policy respond? If damage caused by a third party, policy will respond to pay the damages, but then we can seek reimbursement seeking from the party who caused that damage. In those cases, you need to help the insured seek those things. And basically, there are three things that the third party who caused the damage to it, the physical damage, doesn't pay. We already talked about the deductible. You can recover the deductible. The second thing that you'll talk about is if there's uncovered items. It's not uncommon where you have the tractor covered physical damage and not the trailer. And so in those cases, the person who caused the damage to both tractor or trailers, the insurance company is going to address the physical damage on the tractor they had an interest in and try to seek that. But you would need to help the insured to also seek the coverage for the uncovered item. That would be the trailer or that forklift thing on the back. And also you can recover the loss of use. So you need to help the insured at this time to recover things that are not covered in a physical damage, that they were damaged when a third party is involved in the case, meaning your insured got hit, you got run off the road, and the other person is liable for those damages. Now let's shift to third-party liability. These are the ones we pay the most attention to because these are the ones that have the higher limits and where we have to offer defense in these things. It's a contract of indemnity. The insurance company agrees to indemnify the insured for damage they do to the public for payment of premium up to the limits if not excluded. That's the key. The policy agrees to pay and to defend. The two policies are auto liability and general liability. Smaller motor carriers will typically not buy a general liability policy unless their customers require it. But you need to offer it as a retail agent. You need to make sure they know you offered it. And the problem I have is the smaller motor carrier who might not want to buy it up front, you not explain to them, particularly one who's fairly new in business, sooner or later during the year, you're going to run into a customer who will not give you a load unless you have general liability. It's easier to put it on the policy today. And general liability is one of the best buys in insurance today. The premium for general liability, depending on location, is not all that much expensive. It's $400, $500, $600, depending on the carrier and the location, for a great number of units. So that, compared to auto liability, that's not too expensive. So it's better off to offer it up front, because sooner or later the customer's going to require it, and the loss of revenue for that one load they could not haul will pay for that premium. They need it, but again, you need to encourage them to buy it. Those are smaller motor carriers, 4 or 5 units, who are fairly new in the marketplace. Let's start with general liability, only because that's we're talking about they're not buying. Here's important: provide coverage for anything the insurer does if not excluded. This is where it starts. And so, yeah, we exclude auto liability, we exclude professional liability, we exclude E&O and D&O, EPL, and those kind of things. Concern with general liability, does insurer have operations other than auto? If you have an individual proprietor, yes, they can have a daycare center, they can have a weekend job, those things. Here, LLC and corporations, there it's not so important, because most of them we can look at the financial statement and see where the money comes from. If they have a brokerage or a leasing company, again, in the same legal entity, you want those separated. You also want to look at the use of force to protect personal property if they have guns and dogs. The policy will address that unless there's exclusion. Most insurance carriers who write this arena will exclude guns and animal bites. And your primary exposure is use of owner-operators. This is where the owner-operator is on the insured premises. They get injured, the employee exclusion does not apply if that injury is caused by the insured's negligence. Even if the owner-operator has an ACA Act policy, or even if they have their own work comp policy, they can still sue your insurer, and general liability will have to respond. Use of mobile equipment. Cranes, but mainly forklifts, unloading, that's a general liability exposure. And then if they do responsible for any loading, unloading, where auto stops and general liability starts is a concern that you would have, particularly from the completed operations standpoint. So if your insurer is drop and hook, then they don't have that, but anything other than drop and hook, you need to look at the responsibility for loading and unloading the cargo and damage to the public while doing that loading and unloading. Let's through the main coverage we have, the premium dollars, and the concern we have for the insured, and every insured buys auto liability. Why the government makes that? Because for a for-hire interstate motor carrier, proof of financial responsibility is required. At state level with Form Es, and at federal level with a certificate of insurance sent to the federal government if they have an MC number, which is a 91X, or an endorsement added to the policy, or an endorsement added to the policy, which is MCS 90. The insurance company will meet the requirements so the motor carrier is legal. It protects the public, but understand it does not protect the insured. It only becomes in play, either 91X, MCS 90, Form E, when there is no coverage. So you need to understand it extends no coverage to the insured. If no coverage and the insurance company has to pay judgment, they can then seek reimbursement. So we want to focus on coverage, not on the 91X, MCS 90. A lot of times, and the Form Es, a lot of times the insured, or a lot of times even the insured's customers feel if they have a 91X or motor carrier MCS 90 endorsement, then that's coverage. If you hear an adjuster, if you hear a lawyer, if you hear anybody call any of this coverage, then you need to run from it. They don't understand the product. The coverage is in the policy form, and they will pay whatever the policy says to pay. If there's no coverage in the form, particularly auto liability will be the auto they use is not a covered auto, or there's no pollution coverage caused by cargo in the form, then the insurance company would have to respond. But it was not going to protect the insured, because now when they make a payment of a judgment rendered against the insured for the use of that auto that's not in the policy, then the insurance company has the rights to seek reimbursement from the insured. That's the key part here. So always tell the insured this isn't coverage, and sell them coverage to meet their operations. For coverage to respond, the cause of accident is from use of a covered auto. Those are the symbols. Most of the ones you're going to use is specifically described. Smaller motor carriers, that's less than 20 power units, then the unit must be listed in policy. Unit meaning tractor and trailer. The insured must tell the insurance company about all units they will be used as a part of their operation, owned and leased. Again, tractors and trailers before the use. The insurance company who provides 91X, MCS 90, and Form Es, they have a concern because they're going to have to protect the public if they don't have that policy, that unit listed on the policy. So an insurance company will monitor use of these units from inspection. And so what the insurance company will look at is the inspections in the safety management system and the serial numbers of the units being inspected to make sure they're listed on the policy at policy issuance and during the year to monitor those things. And if not listed, they're going to call up and say, why aren't they in the policy? And this is how it's monitored, and how to make sure that they're insuring all those vehicles 10,000 GVW or larger, that the promise to protect the public is triggered by, to make sure that the coverage is for those units. Other covered autos, hired, added to specifically described, these are owner operators. If listed, you would have the owner operator not be covered under the hired auto. You'd add endorsement CE 996. If not listed, it would be covered, but they'll be auditable. And so that would end up how we get a premium for that. Any auto 10,000 GVW or larger, these are for your larger motor carriers. These are where you're comfortable, and there will be for a monthly reporter, and that's where you collect the premium on a monthly basis, and insured gives you the exposures. It could be the list of vehicles, or it could be the miles or the receipts generated by those vehicles, and that's what the premium would be tied to, those monthly reports. You look at the reports activities monthly because there'll be a minimum premium, and that minimum premium hopefully will not be monthly, will be annual. So in times of accelerated business or reduced business that might happen, you need to make sure that those minimums are going to be met. And if you see they're not going to be met, you need to talk about that up front as soon as you know about it to make some adjustment. The worst thing you want to have is ensure from their activities generate a premium level that's less than the annual minimum, and now the insurance company then charges for the annual minimum. Note, some companies build in the requirement to be listed in their insurance agreement, and so this is like Progressive and others. They say the vehicle must be listed to be covered. They don't use symbols. Make sure autos used by the motor carriers meet the policy requirements to be a covered auto, either listed for specifically described any auto 10,000 GVW that the revenue or the miles or they're listed on the list, or if it's owner operator, see that the proper endorsements added, and you don't want to cover them under the hired auto because that's going to be a punitive premium audit, and so you want to try to avoid that. How does the policy address bodily injury and property damage and environmental restoration caused by the insured cargo? That is a pollutant. That's the key differences here. Standardized auto policy will not provide coverage for pollution damage caused by the insured cargo. They require adding endorsement CA 9948. That is a concern. So anytime you write a for-hire motor carrier, you have to ask the insurance company, how do you handle pollution losses caused by cargo? In the marketplace, the great number of carriers you'll use automatically add the CA 9948. If it's not there, you might have you have a concern because that coverage is available in the marketplace. It's the obligation to address the pollution damage, even other cause of release. You subrogate back because pollution is absolute liability. So we have to respond to those. That's the pollution caused by the fuel in the tank or the insured cargo. And so that's where the policy can, carriers will be different. A lot of carriers do not offer it. You'll have to buy a standalone pollution policy, or hopefully you can get the CA 9948 buyback endorsement. And not all of those are the same. Some of them are not subject to, will have a sublimit on them, and some of them will have specific items that are pollutants. So you need to look at that concern you have. No matter what they haul, that is the concern. Who's insured? That's the legal entity. That's the name of the insured line. Permissive user, driver, user of the covered auto. That would mean by you loan a trailer. This will be an employer, owner, operator. Anyone else who's liable for the conduct of the insured. That's vicarious liability. They didn't actually do it, but they're responsible for it. That could be the shipper, the broker. That's built into the policy, standard ISO, that's blanket additional insured. But it does not cover the owner of the auto. If it's owner operator, you have to add endorsement CA 9947, employees lessor. If it's a leasing company, pack car or Hertz or Ryder, they'll add CA 201, additional insured lessor and loss payee. Owner operator, CA 9916, hired autos specified as covered autos you own. So those endorsements you want to make sure they're added if the units are listed on the policy. Even if the unit is owned by the owner of the legal entity, you have to add that 9947. Owner operator, independent contractor. That's unique to motor carriers industry. Nobody else uses owner operator the same way as a motor carrier because nobody else treats that owner operator and that owner operator's unit just like an owned auto. And because what happens is that the owner operator now can use the registration of the authority of the motor carrier. And so when that happens, there must be a lease based on the FMCSA. And what that lease says is this owner operator, this unit that I do not own, has the right to use my registration, to use my DOT number. But because I'm the registered person, because I'm the entity the government allowed to operate, I'll be responsible for all the activities of that owner operator as they're using my authority, my registration. So that's on-road activities, that's those inspections, that's CSAs, not going against the owner operator, it's going back against the motor carrier. And any damage to the public, that means the liability is going back to the motor carrier, not to the owner operator. That's what's unique now. We can't say, oh, we're not responsible. They're independent contractors. In the trucking industry, if you're insured using an owner operator, and then owner operator is operating under that lease, owner operator is operating under the insured's authority, under insured's registration. If they have a crash, if they damage the public, the motor carrier is responsible to respond for those injuries. And if there's no coverage, by the way, we go back to the 91X MCS 90s, which makes the motor carrier responsible. Will the owner operator provide primary coverage by the motor carrier? If the unit's listed, that's where you have to add 9916. If not listed, any auto 10,000 GVW larger, then the coverage will be based on the written contract you have. And that's important because, again, that's a requirement of FMCSA, and we need to see what that written contract says. That's where the differences in the business auto coverage form and the motor carrier's coverage form in the marketplace. It's how it addresses coverage for owner operators used by the insured. There's no other difference here. So don't get hung up on the title. Some carriers are using the Business Auto form, Progressive being one. That's what theirs is based on. National Indemnity might use it with the motor carrier's endorsement on it. Some carriers offer both. The key part here, if they use owner operators, it makes no difference. Unless they use owner operators, it makes no difference which form you use. You got to see what the coverages are. Auto liability and general liability. What's excluded in one is covered in the other. That's the use of a land motor vehicle, auto or mobile equipment, licensed for the road or not. If it's auto, then it's an auto exposure. If it's mobile equipment, then it's general liability exposure. And so the key part here is that land motor vehicle required to be licensed for the highway and therefore proof of coverage. If it does, then it's auto. If it's not, then it will be mobile equipment. You also have to have loading and unloading. The general liability policy addresses loading and unloading before the motor carrier takes possession of the cargo. Once it takes possession of the cargo, then it's auto liability, being moved to be the transported unit during transportation and while unloading to the final destination. And then once it gets to the final destination, then it becomes general liability, arriving at the final destination. So if it's any other exposure but drop and hook, if the insurer's involved in it with a forklift, with cranes, or by hand or hand truck, or pallet jacks, or hoses with tankers, you need to look at those exposures and see how the policies would address them and write auto liability and general liability, hopefully with the same insurance carrier. So there's not going to be a question of coverage. It's going to only be a question of what loss line you charge it for and what's the premium base. Also, auto liability, general liability. If loaded by hand or hand truck or equipment attached to the power unit, then items being unloaded from, and those items are dropped off, or the hand truck while unloading does the damage, then it's auto. General liability for loading and unloading by equipment not attached. That's the forklift, the cranes, and the front end loaders. Auto liability, general liability, auto physical damage. Policy coverage forms are in most cases based on ISO filed and approved form. Still important to note the differences that could be individually. However, cargo is a different world. There is no standard forms in cargo. Each form could be different. You must understand what the forms provide, and you must make sure it addresses the insured's exposure. This requires you to read them. I have told the story when I present this that my favorite client when I was writing insurance, it was a beer company. My first commercial policy I ever wrote was for this beer company. They already had a relationship with them because early in my career, I had an International Harvester dealership and I sold this beer company trucks. I established a great relationship with the owners there. Greg and I were great friends. And so when I quit selling trucks and got legitimate business selling insurance, I called on my customers I sold trucks to, and Greg let me write my first commercial policy. And about a week after I delivered my first commercial policy, Greg called me up and said, "Tommy, did you read the policy you delivered me?" I said, "What's the problem, Greg?" He says, "You delivered me a cargo policy that excluded alcoholic beverages. What did I think beer was?" So the first commercial policy I ever wrote did not cover what my insurer was hauling. I learned it early in life that you have to read the policies. You have to understand the policies, cargo being one of the major ones you have to understand because they're all are different. And that's where your E&O exposure as a retail agent is more in cargo, because in auto liability, general liability, we have the standard policies we can go back to ISO, but cargo, there is no real standard. The for-hire motor carrier hauls property of others. During the time the motor carrier has the property in their possession or responsible for, they must take prudent care of that property. That's the bailee responsibility. It's not addressed in auto liability form because of the carrier control exclusion. So the cargo policy protects the insured carrier for damage to other property during transportation, and the reason they have that is because it's not covered by auto liability, general liability, because of the carrier control exclusion. So the first basic use of the cargo policy is to buy back the carrier control exclusion. Interstate operations are subject to the federal law. That's the CARMAC. The motor carrier is liable for damage done to property for any others during interstate transportation, absolutely liable. Even if another party causes damage to the cargo, the motor carrier must pay for those damages. Again, absolute liability. They can seek reimbursement for the entities that caused the damage, but it's absolute liability. It does not make the motor carrier responsible for loss of use or consequential damage, just direct damage. This is the major consideration that you have here, because a CARMAC overrides the common law saying that if it's in your care custom control, you're a bailee. The CARMAC amendment makes a for-hire carrier who's hauling property in interstate commerce absolutely liable, except for shipper error. The cargo policy form for for-hire motor carrier is a bailee's form. It's a combination of liability. Responsible from the motor carrier is liable for damage, loss of property in the care custom control because of CARMAC absolute liability. So for the first trigger coverage is a motor carrier legal liable to the property they're responsible for. That's the first one. But then you have property principles, because now it must be the property must not be excluded. So you have and also the cause of loss. So you got to review the form to make sure what the insured hauls and what's limited or excluded, the type of commodities. The policy limits also property kind of coverage because the maximum payable limit set by the customer, the broker. That's the most it will pay. So you got to verify from the customer, the broker, is that limit going to meet all the value of the items that your motor carrier is hauling. The limit required by the customer broker does not limit the motor carrier's responsibility unless the shipment is based on a release bill of lading. And so you want to make sure, because that limit caps recovery, but your insured later might be responsible for more than that. So you want to verify with the insured that the value of the property is hauling, what is the maximum exposure. It's concerned with different types of property: food, perishable, temperature control, mechanical breakdown, the Food Modernization Act, which could be responsible if the cargo is rejected by the consignee, therefore there'll be no salvage. Protection of the owners, that's warranty. Damage if used even though no evidence of damage. That's pharmaceuticals, that's anything with warranty. They're protected brand. You got to worry about it when the shipper or the consignee has a consent for salvage, because there is no salvage. So there are certain commodities you have to worry about, because a partial loss could turn into a total loss, because the undamaged property had been damaged sheer because there's a crash. A cargo form is the most important claim to be handled correctly. The damaged items are the insured customer's property. If the customer of the insured is not satisfied, they will not do business with that insured anymore, and so that interrupts their future business. Is the form acceptable to the shipper or broker? If not, then they will not get business. So you need to make sure that the claims are handled right, and the reputation of the insurance company that you're writing cargo with will be accepted by the shipper or the broker. Shipper wants to be the lost payee. Lost payee, they're the property provider kind of coverage. The cargo's legal liability form, so the owner of the property is the lost payee by the contract. Additional insured, shipper, consignee, and broker. They cannot be additional insured on the cargo policy because the property is never in their care custom control. So they will not be qualified as an insured. These are things they ask for that you need to understand how the policies work. Recap. Insurance policy or contract that promises to pay direct damage for covered property or address legal liability of the insured. It's important to understand the policies being provided. The cargo form is the one form that will most often be different between insurance carriers. It's the most important policy to review and understand before providing, to make sure the form meets the insured's needs. There's no best policy or right policy. The consideration is, does the policy meet the insured's needs? You got to understand the insured's operation and provide coverage to meet these needs. If you have any questions, we will answer them later after you send them to TRS@mcief.org.